Hey guys, Ken Boyd with the Accounting Accidentally website, where you'll find over 400 blog posts and over 350 links to my YouTube videos on accounting and finance. So it's October 2020 and Quibi is shutting down. Quibi is the mobile streaming service that a lot of prominent people who were involved in this business just couldn't get it to work. It was a streaming short form video service here, as it says in the intro. Now, what's important to know for this discussion is that there were two big assets that Quibi invested in. They invested heavily in content. They were trying to drive people to their content and the underlying technology used in its mobile app. So they made a big technology investment. So the challenges for the business were the business couldn't compete with other streaming services like Netflix and Disney Plus. They made a big investment into content and they made a technology investment. So this is my jumping off point to talk about two types of financial ratios: liquidity ratios and solvency ratios. Liquidity refers to your ability to generate enough current assets to pay off all current liabilities in the short term. Think about over months, several months' time, 3 months, 6 months. Solvency, on the other hand, is the ability to generate assets over the long term to make capital investments that you need to make, like more investments in content and technology over a period of years. So, Quibi had trouble with both of these ratios. I want to talk about some of the ratios in each group. Current assets are assets you expect to convert into cash within a year, including accounts receivable and inventory are the two big items. And current liabilities include accounts payable and any long-term debt payments you must make within the next year, principal and interest payments on debt. So working capital should always be a positive number, current assets less current liabilities, because that means you're generating enough in current assets to pay current liabilities. A lot of this has to do with how quickly you collect cash. Some people adjust the working capital ratio and subtract inventory. Inventory of your current assets is the most difficult asset to convert into cash. It takes the longest period of time. So some people look at the quick or asset test ratio instead. And collecting cash is all about increasing turnover. And when you see we have receivables turnover and inventory turnover, when a company is short on cash, it's very likely that they have a lot of money tied up in accounts receivable and inventory. So if I take net credit sales, sales where I don't get paid cash right away, divided by my average gross receivables, that gives me some idea of how quickly I'm collecting cash. So the idea is to increase this turnover ratio. And in a similar way, inventory is cost of goods sold divided by average inventory. The idea being in both these ratios, you want a big numerator, you want more sales or more cost of goods sold, divided by you want a smaller denominator. You'd like a smaller receivable balance and a smaller inventory balance. So you want to increase the turnover ratios faster, faster, faster to collect cash so you have enough current assets to pay off current liabilities. Let's switch to solvency, which is that long-term view. You can look at debt as a ratio of assets, total liabilities divided by total assets. If the liability number is going up and this ratio is increasing, you're taking on more debt compared to assets. A more common one might be debt divided by equity. How much debt am I taking on compared to equity? And if that ratio is getting bigger, that could be a problem. And finally, times interest earned. When you pay debt, you have to pay interest expense. And you have to pay interest expense out of your net income. So what this ratio looks at is, do I have enough income to make my interest expense payments? Because if interest expense keeps going higher and higher and higher, this ratio increases and it becomes more difficult to pay your interest expense. And specifically, interest expense becomes a bigger and bigger part of your earnings. So that's an overview of liquidity ratios and solvency ratios, and both of those were a challenge for Quibi. Remember, hopping back to Accounting Accidentally, that if you click here in the Get It Now or in the download section here, you can go to 23 spreadsheets that explain accounting. I have a list of what you'll receive. These are the spreadsheets that you can get. The ones that I use in my YouTube videos, you'll get a link to the YouTube video and the spreadsheet itself. So if that interests you and that would help you, you can email me here at ken@stltest.net. You'll get a link to Hightail, which is my cloud backup, and you can download each spreadsheet or all of them at once. Thanks for watching, and we'll see you next time.